Good evening. Welcome to all those joining us live, as well as those watching the recording after the fact. My name is Eric Gitonga, and I'll be your host tonight. We have our second webinar in the AHS-AGHS for Real series. We have Wandia Muya joining us to take us through matters investments. Please take note of any questions you may have during the presentation and type them in the chat box. At the end of the presentation, once Wandia is done with it, we shall have a session where she will go through the questions and respond to any that will have come up in the course of the presentation. Karibuni sana. I welcome you, Wandia. Please introduce yourself, tell us who you are, what you do, and take us through the presentation.
Okay, thank you so much, Eric. My name is Wandia Muya, and I'm from the class of 1990. It's a pleasure to be here with you tonight. And I wanted to just take you through just an introduction to investments. I know most of the people, when they hear of investments or when they think of the finance, they think of very complicated formulas. But in terms of investments is very, very easy. It's something that everybody should understand, so that we don't have people, being scammed. So I'll just do a brief introduction. So of myself. So I'm the founder and the CEO of Finsmiths Investment Limited at Finsmiths Insurance Agency. Finsmith came from, when you talk of Iron Smith, I'm sure most of you know about Iron Smith, what they do. So in Finsmith, we deal with the finance and investment. So basically, I have over 20 years in fund management and investment management. So I've been in the industry for a long time. I started working with Stanbic through the fund management arm of the business, where I was the head of both the business. I was the head of business development for both the retail and also the corporate side of the business. So the corporate was dealing with basically pension management. We managed over 100, almost 200 billion in terms of fund under management. So for most of the big pension funds, we were the ones who were managing. I have also worked. I also worked I also worked as a retail head, which means that I was responsible for coming up with the products for the retail, the retail clients. And basically, these are what you call the unit trust products. So I was in charge of developing as well as the distribution of the product and sales. And later on, I worked there for around 15 years, left, joined CIC Asset Management as head of pension and real estate investment trust. So I assisted in coming up with the pension department of the CIC Asset Management. And also I came up with the product paper for the real estate investment trust. But left after 1 year and rejoined the bank, Stanbic Bank, as the wealth manager in charge of the high net worth clients, where I worked for 2 years. And then I left and started this company, which has been in operation for the last 10 years. So it's a pleasure to be here, and I look forward. I hope this would be more interactive, but I'm sure as we go on, you can actually just ask questions through the chat, and then at the end of the presentation, then I'll take up those questions. So basically, that's about Finsmiths Investment Limited. So it was incorporated in 2013. We've been there for over 10 years now, actually 11 years. And basically, the services that we offer are one, bespoke investment consultancy. So I have both corporate and retail clients that I manage. Basically, my portfolio of clients is over 100 clients. So I have mostly they are retail clients, but I also have some corporate clients. I also offer insurance. So because basically when you talk about wealth management, you are looking from the, from when you're making money. So it's a wealth acquisition all the way to to distribution. So when you talk about wealth acquisition, you also have to protect it. And that's why you have the insurance agency, just to make sure that, when you acquire your assets and invest, then you also have an arm that is actually protecting your hard and investment. Then we have the pension and retirement planning, which basically is the what I would call the distribution part, because this takes care of you when you cannot work anymore. So that's basically about Finsmith Investment Limited. So I'll just go straight to the presentation. Yeah. So what I do is that when I'm presenting, I usually, because I like when it's an interactive, when I can see your faces. But since I can't see your faces, so what I ask clients is, what is the understanding of an investment? And I have always, I've gotten some very, various answers when I ask that question. Some of the clients talk about a car being an investment. I don't know what your view is about a car being an investment, but I know for most gentlemen, especially Busharians driving those high-end cars, for them that is an investment. Somebody talks about a house. So a house is also considered, depending, because we have the rental houses, but again, is a house an investment, or is it a liability? So that is also a question that we look at when you're talking about it as being an investment. Or land, is it an investment? So it's also something that a lot of people, especially Kenyans, if I don't have a kaplot somewhere, kaplot maguta maguta, so it's I have not achieved. So for most Kenyans, land is actually part of an investment. And this one interesting, a lot of people, when I talked about, invest in, this regulated investment, they tell me about multi-level marketing. So that's why I have it. Yeah, but basically, multi-level marketing is basically a business. So whereby they sell using their networks. So a lot of them felt, you know what, I would rather invest here, than putting your money in those strange things you are calling the treasury bills and stuff like that. But basically, just to wind up, I can say that an investment is defined as an asset or item acquired with the goal of generating income or capital appreciation. So anything that you buy with an intention that is going to generate some income stream in future, then that one we call an investment. And basically, if you look at a car, I don't consider as an investment, because I'm told that when you drive it out to the showroom, you've already lost 10% of the value. So basically, it's a depreciating asset. And because of that, I wouldn't consider that as an investment, unless probably you are using the car to generate income. Like we have the Ubers, or you are using it as a rental, a rental car, and so on. Then because it's generating income for you, then I would consider that as an investment. A house, a lot of people have looked at it from the angle of, when you're living in it, is it an asset? Is it a liability? So you also have to consider that, like a house has a capital appreciation at the end. So I would actually consider that as an investment, because the value, it's an appreciating asset, basically. And also, when you look at land, I would also consider it as an investment. So a business also depends on the valuation, because you see, like a business, especially when you're starting up, you usually have to put a lot of money in it. So in as much as you're anticipating value, at the beginning stage, you may look at it as a liability, but as you get value from, like you start earning income, then you can look at it as an investment. So basically, that's what we define the investment as. So I'll just go straight into what I call the investment 101, the fundamental of aspect of investment. And basically, um, there are two fundamental aspects that you look at in investments. I know a lot of people look at what you call the returns, because a lot of people will ask me, what if I tell you about the money market fund, they'll be talking about the which is giving me the highest return. But there's one area that a lot of people don't look at, and that is risk, which is very, very critical. And the fundamental aspect of investment is that the higher the return, the higher the risk. So if you don't take anything from this presentation, please take that as a take home. That the higher the return, the higher the risk. And that's the fundamental aspect of investment. So it's when we are talking of the major determinants, so it's the return versus the risk. But we'll find that there are also other determinants of investment. And so apart from the return and the risk parameters, so we also have the time frame of investment. So if you're looking at investing short term, because probably you have like obligations just coming up, and like school fees, you have to pay your rent, and you need emergency fees, you need your hospital to pay your hospital bills. Then you may have to look at investing in short-term investments, less than 1 year. But if you don't need the money, maybe for longer, you don't need it maybe in the next 2 to 3 years, then you invest in longer term or longer dated assets that we are going to talk about. And basically, time frame is a very, very big consideration, because we said that you are likely, investors will ask to be compensated for the longer that you hold their money. So you find that probably a 91-day treasury bill will have a higher rate, because investors want to be compensated, because you're holding their money. It will have a lower rate than a 364 days treasury bills. We'll talk about treasury bills, but basically, the longer the term, the longer the rates that the investors will require. Then we also talk about the liquidity requirements. Liquidity requirements basically is just about like the liquidity, like if you need the money immediately, or you need it over a long time. So liquidity means that you can access your investment in a short period of time. For those that you don't require, like in the next 5 years, 10 years, then we consider those ones as illiquid assets. So your liquidity requirements will also determine what investment that you're going to put your money into. Then, of course, now we are talking about the age. And that's why we have the Gen Zs versus the Magoti Koko. So in terms of the Gen Zs, they have more time to invest, so they can afford to take more risk with their investments. So, but when it comes to now the Magoti Koko who are now retiring, so they don't have that much time. So you find that most of them would put their investment in some risk-averse investments. So they look at like putting their money in bonds, while the Gen Zs would probably put their investments in asset classes like equity, or what we call the shares, because those ones have higher risk, but they also have higher returns, and this person has a long time frame in which to invest. Then we also look at the financial status. I hope our Dangote is actually listening, because for him, it really, like for him, he might even decide, what, I'm going to go into hedge funds, because he has a lot of money to invest. So he may not look at, you guys, you are concerned about the risk. Can I lose my money? You're holding it so tightly. You're having sleepless nights. But for him, probably that is just a drop in the ocean. So he can take a lot of risk. So a lot of investors who are, financially stable, we are talking of the James Mwangi of this world, so they can actually afford to take more risks, as opposed to somebody who has, a retiree who has, just received 2 million shillings. Probably for him, he cannot even start a business. He'd want to invest in something like bonds, where he's assured of the principal, and also he doesn't want to take so much risk, because it might take him to its maker. So those are some of the considerations. And of course, there's also the tax consideration, which is very, very important. I hope Stallings is listening, because he's the tax expert. He tell you that there are some assets which are very, very tax efficient, and probably when you are considering investment, because you don't want your investment to be eaten up by taxes, then it's one of the assets. There are some assets that you should consider. I give an example of shares. Shares have a withholding tax of 5%. In as much as they are risky, they are also very tax efficient. So those are some of the things that you consider when you are investing. So all that come into play, and you don't just invest because you hear something is good. So you have to look at all those when you are deciding on investment. So now we come to the meat of the presentation. So basically, yes, I can see Stallings is there. Thank you, Stallings, for listening. And probably in your next session, you take these people through the, the tax efficient assets. So, but basically, in terms of remember, I talked about the return and the risk profile, and we said that that's the fundamental aspects of investing. So you can see that for those who did maths, you have the y-axis and you have the x-axis. So the y-axis have the return and the x-axis have the risk. But you also notice that that line does not start at zero. So I would want probably if we were interacting, I would want somebody to tell me why it doesn't start at zero. But basically, why it doesn't start at zero, it's because we say that there exists a risk-free asset. And that's why you can see the risk is zero, but there's a bit of return. And that risk-free asset is what we call the 91-day treasury bill, because we consider that asset as risk-free because it has it's backed by the government, by the sovereignty of the government. And when you invest, because of the short term, it's 91 days, we said that the government cannot fail to repay it. So that's why we say for a 91-day treasury bill, that's a risk-free asset. And all assets actually are measured in terms of risk. They are measured from or benchmarked against that risk-free asset, which is the 91-day treasury bill. So from the 91-day treasury bill, then we have the money market instruments. So if somebody is using a lot of English telling you about money markets, do you need? So money market assets is just basically another way of saying any investment which is less than 1 year. So under this, we are going to, in the next slide, I'll cover that. But basically, these are now the treasury bills. We talk about the treasury bills. We have the fixed deposits. We have the call deposits. We have the commercial papers. I will talk about all those instruments. So all those ones which are less than 1 year, those ones are called the money market investments. Then we move to fixed income. Fixed income is another term for bonds. So if somebody is telling you about fixed income, please don't panic. That just means bonds. And bonds usually are issued by the government. They're actually borrowing by the government. Or you can have even borrowing from the corporates. And basically, when they borrow from you, they promise to pay you some interest periodically, and then pay the principal after a certain terms. So if it's a 1 year bond, then they are going to pay after 1 year. If it's a 10-year bond, then they are going to pay your principal after the 10 years. But basically, during that period, they'll be paying you interest every 6 months. So that's basically the bond fund. Then I can see somebody asking what's the difference between an asset and an investment. And probably I can just respond to that. An asset, we say, is anything of value. So I can talk about something like you have when you talk about like in finance or in accounts, you have what you call the assets. The asset is anything of value. Then you have the liability, as opposed to a liability. A liability is something which is taking away from taking away money from you. But basically, an asset and an investment should be the same. So an asset and an investment, because there's anything of value. But a liability is something which takes away money from you. But there's something we call the net worth. So net worth is basically the asset. So you look at the valuation of all your assets. Then if you deduct your liability, then you have the net worth. And we find that you can have a positive net worth or a negative net worth. But basically, an asset and an investment, because both of them are income, like they give you some income stream and give you some capital appreciation at the end, then we call that an asset. So I hope I haven't I've responded to Wambaire Chege. I can see your question. So basically, I can just continue with the presentation. I'll be looking at the questions. If they need a lot of explanation, then I'll come back to them at the end. So we also have the fixed income. We have the balance fund. So I've talked about the fixed income. So the balance fund basically is a mixture. It's a portfolio of different assets. And I know a lot of people have heard about balance, a balanced portfolio. It sounds so complicated, but basically that is a mixture of different assets. So in a balance fund, we may have all those assets that you see there. We may have money market, we may have fixed income or bonds, we may have shares, we may have land, we may have private equity, and we may have alternative assets. And basically, this is supposed to give you diversification and manage the risk. Because what we say is that when you invest in one asset class, you are exposed to the risk of that particular asset class. So if you're only investing in land is very liquid. So when you need the money, then you might not be able to get it as fast as you'd want. So what you do is that you now have to think of balancing your portfolio by investing in different asset classes so that they can they can give you the liquidity that you require. And secondly, they are able to manage the risk of that portfolio. So that's why we have like a lot of pension funds are actually invested in a balance fund, because it looks at all the risks and try to average out the risk of each asset class. Then we have the shares or equities. Again, I'll talk about that. So those ones you can see in that spectrum, in moving up that line, you're going to say they are more risky than the balance fund. Why? Because shares move up and down, and in terms of investment time frame, they are considered long, medium to long term. So in terms of risks, shares are high risk investments. So if anybody is telling you about, I've seen a client of mine, I was telling them today about, they had like around $5,000 they wanted to invest. And somebody at Stanchart was convincing them to invest in equity, offshore equity funds. And what I was telling them is that anything with equities is high risk, which means that if you want your money at any one time, you have to look at the underlying prices at that time. So it's not really, if you are risk averse, it's not something I would advise you to put your money into. Then you have land or property. Of course, everybody here, I'm sure, all of us here has a kaplot maguta somewhere. So land and property, a lot of people say the value always go up. Yes, they are appreciating assets. But why we consider them high risk or long-term, it's because, first of all, they are long-term investments. When you need your money, you may not be able to get it. They are quite illiquid. And that's why, in as much as a lot of people are always thinking that they are certain, I'm told there's some people here who invested in a certain real estate business, and when they went for their money, they were told, unfortunately, we cannot give you your money back. And for them, at that point in time, I'm sure they were like, you know what? You can never go wrong with real estate. Why are we being told we can't get back our money? Because uh, people sold that aspect of, for land, it always, the prices always go up. But yes, they go up. But what about the liquidity? So that's why we say for land and property, in as much as they are good investments, they also have that risk of being illiquid. Then we have the private equity. I talk about that. And finally, we have the alternative assets. So basically, that's how. If you are investing in anything, then you should always remember that line, and try to gauge the risk of that investment versus the return. So I just talk, and I know I've talked briefly about it, but the money market investments, we say they are short-term investments, less than 1 year. They are usually low risk, as you saw in that spectrum, that line. They include the following. They include the treasury bills. So treasury bills, I think I've seen a question about treasury bills somewhere. Treasury bills really risk-free, considering what has recently happened in some countries, e.g. Ethiopia and Ghana, where the government failed to pay treasury bills. Yeah, so we say treasury bills, especially 91-day treasury bills, all around the world. So apart from maybe some of the sub-Saharan countries where the government has failed to pay, so we say the government will always pay. It's always like a given. But we have seen that in some circumstances this may not be the case. But for a majority of countries, the government has that that commitment that for treasury bills they always pay. So that's why we use it. We say it's actually a risk-free asset, and we use that one as a benchmark for all the investments. So yeah, I've seen the concern, but basically a treasury bill is considered the a risk-free asset. So even if you go into the finance literature and read, the LIBOR rate, and the treasury bill is always considered a risk-free asset. So they are short-term lending to the government, and they are principal guaranteed. Treasury bills are usually what we call discounted securities. So the government sells at a discount. So for those who have applied, you actually apply through the Dow CSD, and you give a rate. They calculate for you. They tell you pay probably for 100 shillings, pay 99 shillings, and then at maturity you get 100 shillings. That's what we mean by discounted. So we have in Kenya we have three types of treasury bills. We have the 91 days, currently at around 14.7%. Then they've been giving some very, very high rates, but they've been recently, like the last auction, they came down. So we also have the 182 days, which is basically 6 months. And then we have the 364-day treasury bill. So we have three papers. So if for those who look at the central bank, the Dow CSD and the central bank website, then you are going to see those three instruments, which are the 91 day, the 182, and the 364 days. Then we have the call deposits, which are issued by banks. Then we have the term or fixed deposits also, which are issued by the banks. I always tell people the difference with for banks, for banks, what they do is that they have to raise the deposits to be able to lend. So to raise the deposits, they need to compensate the investors. And because banks are also considered low risk, they don't actually pay as much on fixed deposits or call deposits. So you find that because their work is not investing, they are just getting the money to be able to lend. And the way the bank works is that they need to make money from what you call the net interest margin. So if they can give you as low a rate as possible, then for them that's good for them. But for instruments like now what you call the money market funds, These are what we call the regulated pooled funds. So regulated means that they are regulated by the Capital Markets Authority. Pooled means that we have many investors who come in and put their money. So one we put 5,000 shillings, another one we put a million shillings, another one we put 20 million, another one depending on their strength. And all this is pooled and invested in a pot. So the returns that the on the underlying investment, the returns is actually given to the investors. So they give they get the same rate. So it's not that like banks, for example, if you put 100 million, you're going to get a higher rate. But for a money market fund, they give one rate. So if you put 5,000, if you put a million, if you put 100 million, you're going to get one rate because it's actually almost like a cake, the way a cake is. So you may get a small piece of the cake, but the ingredients are all the same. So just think of a money market like that slice of the cake. So they are very short term, and we say they are low risk. And why we talk about low risk is because they are not guaranteed. Like when you talk of the treasury bill, it's guaranteed by the government. So these ones are not guaranteed. So yes, there's exists a risk, and most of the risk may also be issuer related. Like I can ask a question, for example, why do you have some money market funds offering 18% when we are talking of the treasury bill being at around 14.7%? And a treasury bill is locked for 3 months. Well, for a money market fund, it's not locked, which means that it's very, very liquid. So you can see that if an investment is giving you 18%, I looked at the rate ranking today, and I can see one which is giving 18%, another one is giving 17%. So you ask yourself, where are they investing? So don't just go chasing returns. So look at the fundamentals. Where are these guys investing? So ask those hard questions, and don't just invest in anything just because it's giving a return. So so they invest mainly in short-term money market instruments. So basically, we are talking of the treasury bills, short-term treasury bonds, and also we are talking of call deposits, and we're talking of fixed deposits. Then you have what you call the commercial papers. And I know a lot of people, when it comes to those terms, they are like, oh my God, what is a commercial paper? But basically, this is a short-term lending to corporates. So the risk associated with the borrowing corporates. So the risk, there's a risk because I think of like a corporate like Chase Bank, for example, which had issued for Chase Bank it was a corporate bond, but Nakumat had used to issue commercial papers. So commercial papers was actually borrowing from from institutions, from high net worth clients to finance their operations. So those ones are also considered quite high risk because, as you saw for Nakumat, when it went under, it actually went under with people's money because they thought it was a big brand, it cannot fail, and so on. So that's why we say, in as much as commercial papers are short term, they also carry an element of risk, which is associated with the borrowing corporates. So they may have the similar characteristics to shares. So for money market funds, that's basically what I deal a lot with. So they are short-term or short-term investments, which is less than 1 year. Collective investments. So collective investments is the same as pooled funds. So if you see collective investments or unit trust and all that, they are called the pooled funds. So a money market fund is basically a short-term parking for cash. So you're putting that cash for a short time, and it's regulated by the Capital Markets Authority in Kenya. So I call it a regulated investment. Why I deal with the regulated investment, I know you've heard of this a lady, I think she's called Pascalina Peters, or and she scammed people a lot of money, over 300 million shillings. And if you are to look at some of these investments, they are not regulated. So people just, do like word of mouth. We've had a lot of scams whereby people, they lose a lot of money because these assets are not regulated. So being a regulated asset is very, very important because it's there to protect you as an investor. So they are low risk. So we say that they can't be perfectly, they can't have, no risk. So they are low risk. They are principal protected, which means that you'll get your principal back. So the only thing that may change is the interest rate, but in terms of the principal is protected. Then the daily accrual of interest and monthly compounding of interest. So the interest accrues on a daily basis, and at the end of the month, or the interest, because the interest may vary during the month. So at the end of the month, all the interest which has accrued over the month is actually is actually credited to your account, and because it's added to your principal, then it compounds on a monthly basis, as opposed to if you put your money in a 3 month fixed deposits, whereby the money will mature after 3 months. That's when you get your interest. So you get like it compounds like on every 3 months. But for a money market, it compounds on a monthly basis. So is easy access to funds. You can easily access funds plus accrued interest. So it's not locked, and it's a great investment for parking cash as you await investment into other asset classes. So if you're looking at, for example, you want to buy land and you want to park your money somewhere, then this is a very, very good investment to park your money. If you're looking at probably you're a real estate company and you want to buy land, and properties, then you can put it in the money market fund as you await to invest into the other asset classes. So it's offered by various asset managers, with some offering as high as 18%. So I've talked about 18%, which for me does not look good because of the risk associated. If I don't understand the risk associated with it, I wouldn't recommend that my clients invest in that. So that's basically about the money market fund. So we have various. For me, the ones I usually recommend from sound investment companies. And most of the companies that I recommend are affiliated to big financial services groups. So I would recommend a company like Jubilee. There are also banks like Stanbic, they are KCB, those are affiliated to big groups. But when it comes to standalone fund managers, then I'm a bit hesitant, because if anything happens, they are taking maybe a bit more risk. In as much as they are regulated, then it means that the clients are exposed. So that's why for me, I would recommend, I work with all asset managers, but I recommend a few based on my interrogation and also, interrogation and also understanding of the market. So basically, that's how the money market fund works. So you can see the various months from January to December, and you're assuming a return of 16%. Of course, the rates have come down from 16. Now, like Jubilee is around 15.5%, because basically they will come down depending on how the asset classes. I told you they invest in treasury bills, they invest in fixed deposits. So they'll come down depending on how the market is performing. So you've seen the treasury bills are coming down, which means that even the money market fund rates are likely to come down. But the good thing is that they don't come down drastically. And usually they'll be much higher than what is being offered by banks, or probably the treasury bills. So most of them will have a higher rate because they have a better asset allocation, and also because of the fact that they are they are investing. They have that economy of scale, because they can call a bank and say, what, I'm giving you 2 billion shillings. How much? They have that negotiating power, so they can be able to get a better return than when you do that on an individual basis. So that's why the returns will be slightly higher than, they'll be much higher than even the bank rates. So as at January, you can see that's a million. I'm just assuming it's a million shillings. And basically, You can see the interest. So interest will be accrued on a daily basis. So assuming the rate is constant and averages around 16%, it will going to differ obviously, but say on average is 16% for that month. So the interest earned will be around 13,500. Then this 15% withholding tax, which is a final tax. So so you have that's 2,000 shillings. So the closing balance will now be 1,011,000 shillings. So this one will now be is the capital that we move into February. So you'll be earning interest now on 1,011,000 shillings. So not 1 million. So it's 1,011,000. So if you assume the same rate, so you're going, February is a shorter month. It's 28 days. That's why you find that the interest has gone down slightly to 12,400 because it accrues per day. So the withholding tax is around 1,800. So you can see that now the closing balance will be 1,022,000. So in March, the same thing happens. So that principle is compounded, and then it forms part of your principal balance at the beginning of the month. So until the end of the month, so it keeps on compounding, and that's why we find that at the end of the year, you have the annual effective yield at 17% and not 16%, and that's the power of compounding. So you can see you are earning another 1% because of that compounding factor. For fixed income or bonds, I had explained earlier, so I'll just briefly talk about through this. So they are medium-term investments. Medium-term investments mean over 3 years. So anything medium-term. Of course, we have 1-year bonds, which are not issued as regularly as other bonds. Then you have 2-year bonds. Then you have 3-year bonds, and you have up to 30-year bonds. So we say they are medium-term investments. So if somebody is telling you about a bond fund, then it means that that investment, you should consider an investment frame of around 3 years. So they are more than 1 year. They're usually medium risk. And then they have different terms. So you have 1 year, you have 2 years, you have 3 years, you have 30 years. And they include the following. So you have the treasury bonds, which are lending to the government for more than 1 year. So government borrows from the public and pay a fixed amount of interest semi-annually. So I'd explained that the government, because they need money for their operations, then they do an auction. So every Thursday, they do an auction. So actually it's Wednesday, so they do an auction for bonds. Then banks, insurance companies, then retail investors are going to apply, and then by Friday they give you the results, and then you're supposed to settle the amount by Monday 2 o'clock. So basically that's how bonds work. So we have various bonds. So I know one of my favorite was the 6.5 years, which was done sometimes in August. Was it August or? Yeah, I think around August. And it had the best rate at 18.4. It was an infrastructure bond. Infrastructure bond means that the government will be borrowing for a specific purpose, basically for infrastructures. And the good thing about an infrastructure bond is that for now they are tax-free. So which means that you actually get that 18.4%, and they want to deduct that 15% withholding tax. So so those are treasury bonds basically. Then we have the corporate bonds, which are lending to corporates for more than 1 year. So I talked about, Chase Bank, for example, had a corporate bond. These days there are not as many. South Africa used to issue. So basically, these are corporates which would actually be in the market borrowing. Then even EABL had a bond. So basically, those are lending to corporates. Then you have Euro bonds, which are denominated in other currency other than the currency of the issuer. So you find that like Kenya shilling, for example, Kenyan Euro bond will be denominated in dollars, and it's actually basically a borrowing. Even for investors here in Kenya, you can actually be able to buy a euro bond, but it's going to be denominated in another currency other than the currency of the issuer. Then you have the sovereign bonds, which are offered by by governments. So basically, that's a fixed income or bonds. So for those ones, if you hear bonds, they are not very very complicated. It's just that the government is looking for money and want to borrow from you, and they are going to compensate you for that. So the way they do it, they are going to pay you interest regularly every 6 months, and then they are going to pay the principal at the end of the maturity period. So is the withholding tax specifically on the gains? Yes, it is. So it's just the withholding tax is on the interest, not on the capital. So you have the balance funds. I talked about this. So balance funds are medium-term investments. We talk about 3 years and above. Usually medium risk. Usually invest in various asset classes such as money market funds. They invest in equities. They invest in fixed income. All those, property and alternative assets. I talked about most of them being pension funds, and they provide the why they invest in all those asset classes is so that they can be able to diversify the risk. So we have shares. I'm sure a lot of you have invested in shares, and some of you got banned. Yeah, so shares are long-term investments. So a lot of people went into shares, especially those years when around 2010, 2009, 2010, everybody was talking about shares because they were making so much money. And for a lot of people, they would actually just give an order, please buy for me shares. The next day, those shares have moved. Like even when you talk about the Kengen IPO, you talk about even shares in the market, Kengen and so on. You'd actually buy at like to 5 shillings. The next day is 7 shillings or 10 shillings. So you're making returns over 20%. And basically, a lot of people put their money there and got banned because they didn't understand that they are actually long-term investments and they're high-risk investments. The same way you make money easily, you can lose that money very very easily. So basically, a share represents ownership of a company. So when you're buying into a company like BAT company, you now become a shareholder. Unajua wale wa Murima, the Murima guys. So you become a part of that Murima investor. So you are part of the owners of that company. So returns are usually in dividends and capital gains. So you can earn a dividend, and you can also earn a capital gain. For me, when investing in shares, I always tell people, please know that don't just go there unless you are a high risk investor. Don't just go there to speculate, because you can be able you can actually burn your fingers. So you can invest. You can do a fundamental analysis of that investment in shares, so that you understand the main drivers. And usually we look at dividends as more, they give an indication of the performance more than the capital gains. So dividends are not fixed or certain, as they depend on the company's performance. As usually, the shareholders are paid the residual value after what is left after everything has been paid, including the debt holders. So that's why we say for shares, they are quite uncertain. So you find that 1 year you get a dividend, the next year you get a dividend, or probably you get a very high dividend. Some of these companies like BAT, if you have to look at the dividend yield, it's currently at around 14%, which is very very good. And some of these industries like the tobacco industry or the beer industry, some of these industries that you may not go wrong. So those are maybe sound investments, and you can actually you can actually make money if you look at the fundamentals of the industry that you are going into. Then share prices may go up or down depending on various things such as prevailing macroeconomic factors, company performance, etc. If you are to look at shares, I know for the guys who have invested in shares, I'm sure there are some here who are listening to me. There's some who have made money because actually in the last 1 year, if you are to look at the NSE index, it's done over 20%, around 23, 24%. So some people have made money, but others, depending on your stock pick, may have lost money. So that's why it's always good to to understand the fundamental of the shares before just investing and doing speculating. So land property, I talked about it. Of course, all of us know about land. They are long-term investments, usually more than 3 years. High risk, high risk because mainly of liquidity. I talked about that. Ideal to have in a balanced portfolio because of price appreciation over time. Performance is affected by prevailing macroeconomic factors. So you've seen, like, for those who went into property around 2009, there was a time everybody was just talking about land. Watu walinunua Kamulu, wengine wakaenda Kitengela, deep. Even it was like a gold rush. Everybody was buying land, Kashamba. But right now, when you try to sell that land, you find that you cannot even get that value, or you cannot get a buyer. So there's a risk in terms of even some of the land, like in Kenya, is highly overvalued because of the fact that there are also brokers involved. So you find that you bought some land, you thought it was an investment, and then when you go to sell, then you find actually you cannot get a buyer for the price that you're looking for. You actually, if for example it's an emergency, you even have to sell at a loss. So those are some of the risks which are associated with land or property. Then we have various investment options. So you can do land banking. Land banking is just basically buying land with no development and just waiting for it to appreciate. Then you have residential, like your apartments, the apartments that are all over. Then you have the retail. Retail are usually like the malls. You have the commercial and you have the mixed use. So you have all types of properties. And the way you value properties is usually using what we call the rental yield. Rental yield is basically the the annual rent that you are getting from that property divided by the value of that property. And you find that in as much as we have hyped property so much, in Kenya, the rental yield is quite low. It's actually between 4 to 8%. But we usually buy it because of the significant capital gain, which again are also it takes a lot of time before you actually actualize that capital gain. But that's basically why a lot of people invest in land. I'll talk about the cryptos, though I don't have a very sound understanding. But basically, for these cryptos, I'll talk about it in another slide. So allow me to go to the next slide, then I'll cover it there. I can see SIB with Mansa X. That's another fund that I also can say I've gone through it. And basically, I didn't understand what the underlying investments are. They talk about commodities, they talk about like gold and stuff like that. I don't know how they value those assets. So basically, for me, anything that I don't understand, unless I'm putting a small amount of money just to speculate, I wouldn't actually put a lot of money in it. If you don't understand it, please don't put your money into it. And that's what I tell the investors. Let somebody, like take you through like a toddler, so that you're able to understand. Like when they talk about commodities, what commodities and how do they value those commodities? So that's why I wouldn't talk so much about SIB, but I understand they have been giving very high returns over a long time. For me, I would say it means that they also have an element of risk. So if kikiumana, then we will be here waiting. So it's something you can do, but just do it with with some caution. So I just go to private equity. So this is actually more risky than shares, because basically this is an investment in what we call the unquoted stocks. So they are not offered in the stock market. When you talk about the stocks or shares, they are usually traded through the stock exchange. So for private equity, they are not traded in the stock exchange. So it's just somebody can come in and decide, you know what, I want to invest in a company because of the fact that I see growth prospect in this company. Probably it's a startup or a family business. So somebody decides, you know what, I want to put money into that family business. So these are usually long-term investments. So most of the people who are putting money are investing for uh, basically around 7 years. So usually more than 3 years, but basically around 7 years. They are high risk and high return. So it's just like a startup business, the same way you hear about angel funds, it's a high growth area, but it can go anyway. So that's why we talk of it being like a high risk, high return. Uh, so they are unlisted shares of venture capital. So they requires professional advice because of the high risk involved. And usually most of them we do, memorandum, like just a prospectus, just taking you through, before you invest, so that you are able to understand the underlying risk of that investment. The returns can be as high as 30%, so that is a very, very good return. So, like I've seen a lot of companies now investing in this microfinance, like institutions, MFIs, or agribusinesses, because the returns can be quite high. The venture capitalists usually look for high growth areas whereby they invest capital, then they provide management and exit after a number of years. So you find that a lot of the private equity investments, when the investors have gotten value, they exit. So they can exit through issuing shares in the stock market, or they can invest through inviting other shareholders to come in and pick, and invest in that company. So they have a way after 7 years, when they have invested, they have a way of exiting. And for most private equity investors, they actually look at that risk, but they're looking at getting the return before they turn around the company and exit, and then they sell it to other shareholders, who probably after that, probably the return will not be as high as when the venture capitalists were managing the business. So we can move on to the next slide so that I can talk briefly about the cryptocurrency and the Binance assets. I'm not going to go deep into this. Probably we'll need Chris Kamau. Probably you will need a session to take us through that. But basically, this just to let people know that it's not cryptocurrency is not a bad investment. They are they are called alternative assets. So alternative assets are assets which are not in any other. They are not in your standard portfolio, and usually we say they are for speculative. Most of them are usually speculative, and they are high risk, high returns. They are long-term investments. I would say they are long-term because anything which can go up and down means that it has the risk is quite high. So when you are going into anything like cryptocurrency, or you are going into anything like hedge funds and so on, don't just go there for 1 year or put your school fees or your medical fund into some of these investments, because if anything happens, then it means that your money is gone. So they are not there to speculate, and usually most of them are actually for what we call sophisticated investors. So if you're not sophisticated, probably you need somebody sophisticated to take you through the investments. And that's why I said I'll talk about it just in this introduction, because you can see they include tangible assets such as precious metals, like gold. You have art, like Eric's art is part of these alternative assets. Um, then you have stamps. There are people who collect stamps. You have wine collections. Some people even collect guns. I understand even some people like collects, even like attires from famous people like Michael Jackson and so on. So those are now what you call the alternative assets. They have value, but they cannot be valued like in an independent market. Depends on the owner or the person who is issuing. I understand like some of the like cryptocurrencies, they have a valuation mechanism, but again, these are not traded regularly by just any other investor. So, so they include even commodities. Commodities, like we have, like corn or maize. All those ones are part of the alternative assets. So they also include financial assets such as financial derivatives. You have hedge funds. Hedge funds are basically done by the billionaires. The billionaires will want to go into aggressive to invest in aggressive portfolios, probably giving 50% or 100% return. So because they have the funds, then they can pool. They actually pool, and then they invest in what we call a hedge fund. Then you have the cryptocurrencies, which are also digital currencies. Those are digital currencies which are tradable. We have infrastructure funds and distressed securities. So they are professionals who just deal with distressed securities, because they get the distressed security, then they turn it around, and then they sell it. So those are basically your alternative assets, and that's where you get a lot of values, because because of the fact that that value is not just something that everybody understands, but once you understand, you can actually be able to make a lot of like they give you very high return, but you also have to consider the risk associated with that. So therefore, sophisticated investors hence require professional advice. So basically, we come to the end of the presentation. So in conclusion, I would say that investment decision is usually determined by various factors, but mainly is the risk and return. So always remember that. So when you are asking me about returns, also understand about the risks. So once you understand that, then I think you're not going to be confused and be among the hundreds of thousands of people who just chase returns and just get scammed. So the fundamental investment rule is that risk and returns are directly correlated. And one way of managing risk is diversification of your investment portfolio. So to diversify your investment portfolio, ensure you invest in different asset classes and across different industries or geographical areas. So that's why for your investment portfolio, you may want just, you may have Kenya shillings, you may want to consider having a bit of dollars. You may also consider, having a bit of land. So don't put everything in land. Have some bit in other asset classes like the money market or bonds, so that you are, if one of the industry is not performing, then at least you don't lose all your savings. And finally, I would say that this is what I do on a daily basis. I help people have their money work for them through Finsmith. Finsmith is basically the company that I've done the introduction. So if you want to have your money work for you, please talk to me. So thank you so much. So I'm available. You can always get me on For Real. And it was a pleasure having you here with me. Thank you and good night.
Thank you very much, Wandia. Before we close, there's some questions that have been asked from the audience. So we'll
Yes.
probably go through them. The ones that you've already answered, I will not ask, but the ones that
Yes.
haven't been, maybe we can touch on them. So Tabitha asks, hi, Wandia. So is it only appreciating assets that are really investments?
Yes, actually, investment is not really appreciating. We said it's anything which is giving you income, regular income, or just income, anything that you buy with a view of getting income from it, or appreciate in value. So it can be either it's giving you some income, or it's appreciating. So that's an investment. Uh, I know what this may be leading to, because sometimes we take loans to buy assets. So at that point in time, it may look like a liability because you have a loan against it and it is negative net worth. But if you are looking at it, you're investing in it so that it can give you value at the end of the investment, or it's going to give you like a stream of income. That's an investment. If it's not, it is going to take away, like there's some investments we put the money into just for, like this emotional, like just because or say everybody is doing it, or because I've given an example of like a lot of people invest in just probably one cow. So you have one cow, you're just delivering milk and it's just keeping you busy. But when you actually look at the underlying in terms of the income that you're getting into it, you're actually spending more than what is giving you. So that's not an investment. So an investment should give you value. If it's not, then that's a liability. So I hope I've answered Tab's question.
So, thank you. The next question we have from Esther: kindly cover a little about the famous education insurance project, which products which are marketed as investments. So, if you can give a brief comment on that.
Okay. Basically, just to touch on insurance. For insurance, I always tell people, please, insurance is not investment, because insurance is basically you are buying an insurance for protection. And if you are to look at the like the scholar or the education policies, the protection is that if anything happens to you, then the insurance company will come in and make sure that they pay for the children's education. So that's the protection that you are looking at. So don't put your money into an insurance product because you expect a return. I tell you for sure that especially for life insurance, part of the cost, like anytime that you take a policy, like 40% of that, whatever money you put in, is used to pay the agent. So you can imagine by the time you recover that value of that, whatever money you put in. So it may be very expensive at the beginning, but what you're buying is actually the protection. So don't buy insurance for investment. So I hope I've answered that question.
Okay, thank you. The next question we have is from Justina. If you can touch a bit on unemployment insurance income protection as well, comment on that.
Yeah, yeah. Employment, like what you call the retrenchment covers, those are very, very good because at the end of the day, you are looking at if anything happens to you when you're in employment, then you have a cover that takes care of they pay you something once you are retrenched. So, like when you're in employment, probably you have loans, you have, a lot of, like liabilities. So it's always important. Actually, even you find that even your employer will take a cover for you so that if you are retrenched, then you're able to, you have at least, a bit of time before you find your next job. So they make sure that they pay that money. So for me, I would say employment insurance is very, very critical, and it's very, very important. For guys who are working, it's a good product for you to have.
I'll go to the next question, which is from Wambaire. If you can please talk about trust funds.
Or trust funds.
Yes,
So
trust funds.
trust funds. I would say that trust funds. When you talk about wealth management, we talk about First of all, there's the acquisition bit when you are, like asset acquisition. So when you're working and acquiring assets, then there's a protection bit, and then you have the distribution bit. So a lot of people will work very, very hard throughout their life, but they don't think about the distribution bit. And that's why you find that a lot of people actually lose a lot of wealth. When something happens, probably they get incapacitated, or they die, or they get old. So that's why it's important for you now to create a trust. And basically, the trusts are done by, there are some trust companies which do trusts. And trusts are basically a way of protecting your legacy wealth. So you set up a trust. There are various trusts that you can be able to set up, and then you put all your wealth into that trust, and then you have rules as to how the wealth will be distributed if in case anything happens. So that's also part of the wealth management. I don't do that bit, but there are professionals who do that. There are lawyers who do that, and also there are trust companies that offer that service. And it's a very, very important service for you when you are not there to take care of your dependents.
I'll go to the final question that wasn't touched on. This is from Claire. So we have many investment companies out there. What are the red flags to look for?
I would say one of them would be, like, for me, I look at the financial capacity, like the financial capacity of the company. So most of them, like the ones who have been there, if you look at the funds they are managing, most of them overall are managing very, very big funds, like over, like in terms of financial strength, they are managing over 100 billion. So I would say for a company, look at the financial strength. Look at the owners of the company. So if you're not sure of the owners, then don't invest. Look at the like corporate governance around that company. So most of them, like I'll give, like for investment companies, uh, there's a corporate governance structure, especially for the unit trust companies, whereby they are supposed to have like they're supposed to have a custodian bank. They're supposed to have a trustee. They are supposed to have an administrator. So if and also the auditors. So if you look at all those parties and you're not comfortable, then don't invest in that company. So I would also look at the reputation. So reputation, we say, is the word around. You'll hear people talking about a company because in as much as you may have a company which is financially sound, when it comes to the way they treat their customers, but probably they are not customer centric, or they don't have good processes in place. There are delays in terms of investment. Then that is bad reputation, and it's for you when you're investing. Also, you have to think about that as well. So those are just but a few. But in terms of the analysis, we do like a comprehensive, because you also have to look at the risk, the risk factors. What are the risk systems which are there in that company? Risk management, are they robust? Is the company regional? Because if it's just a local company, then and a standalone company, then you may want to question, what risk processes have you put in place to make sure that the investors are protected. So those are some of the things that I would look into.
So, thank you very much. Thank you. Any other questions from the audience before we close? Since I don't see anything coming in, well, Wandia, you have shared how people can reach you. Maybe you can respond, or you can just share with people how they can get to you in case they have any questions for follow-up that they may need to contact you.
Okay. In case you want to contact me, my number is 0722 606 995. So you can WhatsApp, you can write to me on email, muya, muya.an at gmail.com. So
And
I
with
have
an E or without an E?
with Muya and Anne with an E.
Okay.
Yeah. So you can contact me. I know I'm usually online because my business is usually mostly online. So if you have any, I have some clients among you. So they know I'm very, when it comes to servicing my clients, I'm very, very passionate. So if you have any question or you need any assistance, please feel free to get to contact me. I offer the services as I have free, like for small amounts. I offer free services, but if you want for me to structure a portfolio, then I charge a fee for that. Or even for financial literacy, if you just need me to to take you through how to because what I do is I try to design investments for clients. So I look at their specific circumstances, and then I'm able to offer that advisory services in terms of structuring how you can be able to invest your portfolio. So I do all that. So if you need any of those services, please feel free to contact me.
Thank you very much. Asante sana Wandia. We truly
As-
appreciate, and the audience
Asante.
is also registering their appreciation for what you've taken us through.
Okay.
So I'd like to thank you all for joining us for this insightful session. Our next webinar shall be in November. The date specific shall be shared with you in good time. We shall have Bright Shitemi taking us through matters mental health. We realize that there's a lot of importance in that, and especially in our for real asylum. People have mentioned that a number of times. So this would be a good time to just listen in on what involves matters mental health and how we can help each other have a better health in terms of our mental makeup. Lined up in 2025, we have sessions on lifestyle diseases, in agriculture, on financial management, on cacao. And for all these, we are very excited to have people come in and talk to us about what they have on offer. My only ask is that may we have more ladies joining us. So far, Wandia is the only lady that has been scheduled for a webinar, and we want to have more of you Acrosians come and join us. Even though we have these topics set up, me as dictator, if you as a lady come and you want to have a topic to talk about, I will slot you in before the other guys. So please come forth and let's do that. In the meantime, I wish you all a wonderful night until the next time in November. Cheers. Have a good night, and that's all from us. Bye bye.
Good night. Bye bye.
Good night.